Jonathan, you look perplexed.
And Jonathan, I will probably go on to mute between just in case I have like a sip of water or and I think with you being out there, be good
Yeah,
too as well.
I was definitely gonna use that to my advantage.
Cool.
Okay, well, I sure hope more than Debbie comes. We have had these before where there's been just one person.
Yeah, it was me and Mark just hanging out, talking about something that didn't apply to him because he was retired.
Oh, yeah, because I can hear Matt, for example. Jonathan.
Yeah, I might actually just move offices because if not, I didn't just gonna have someone stay. I'm gonna go
Yeah.
run into Brandon's.
Okay. And imagine you can trim the recording to start as we actually start, right, Shannon? Yeah, cool.
Yep, yep, yep. Three people, all ladies.
Ooh.
Debbie, Paul, and Linda. Okay. All right, let's do a little sound check in your new spot, Jonathan.
Sound check. One,
Sound
two,
check.
two.
All right, looking good.
Mhm.
All right. You standing?
Yeah.
Nice. Okay. All right. Well, we're gonna have to let these ladies in here in just a moment. Just gonna let them trickle in. Hopefully more to come.
Ooh, I'm gonna go grab my water. Sorry.
Okay. Hello, ladies. I see we've got Debbie here, Linda, and Paula. But Paula, I can't see your lovely face. I can see Debbie's lovely face.
Hey, Debbie.
I
I
can see
am.
Paula's lovely face.
Hi, Paula.
Hey, whoops.
Yeah.
I
And I'll see
got
your
a little blue tape back on here.
Oh, or you thought we were gonna spy on you?
Yeah, you
I-
did. You said
I
you were
just-
recording everything, so everybody's spying on you.
Yeah, they're welcome to spy on me. They will
Like,
be
exactly.
Are you expecting many?
spies
This- No,
or
this is a new
attendees.
this is a new chapter.
Okay. We had about over 20 RSVP, but it's noon on a Friday. It's hard to know what schedules may have changed. So, but good to see some familiar faces. And Paula, I'll see your face in person tonight. All right, I'll meet you there at 6.
Wait.
Okay, so hopefully some other folks will trickle in just because Michael and Jonathan, my dear colleagues at Brio, are here to outline the Brio investment philosophy, how we approach asset allocation and diversification. And it's just a really great overview of how we're working behind the scenes with your money. Michael is not only a financial planner here, but also a director of operations. He has his finger in every single pie that Brio has cooking. And then we've got Jonathan, one of our newer members, a wonderful associate financial advisor. And we're just super thrilled that you chose to spend some time with us this afternoon. So, as always, this hour's for you. If you have particular questions, feel free to put them in the chat, raise your hand, shout it out. We're here for you. But otherwise, we'll just kind of go through the presentation as is, and there'll be certainly time for questions at the end as well. All right, Michael, here we go.
Thank you, Shannon. And thanks again, everyone, for spending some time with us on a Friday afternoon. I'm going to let Jonathan actually kick us off today. And yeah, hope you enjoy the presentation and again, chime in with questions or throw them in the chat or save them till the end and we'll be happy to answer them.
Perfect. Yeah, thanks, Michael. Nice to see everyone. Nice to see some familiar faces from Fleet Week last week. Yeah, looking forward to talking today. So as Shannon said, today we're going to be talking about asset allocation, diversification, and kind of Brio's approach to the investment world, a little bit of our philosophy on how we build portfolios and how we view, what we want our clients to invest in. So as a quick introduction, as Shannon said, I'm one of the newer members. I joined Brio back at the start of 2025. I'm an associate advisor working for Brandon Miller's team. And I'm joined by Michael. As Shannon said, he's a man who wears many hats, director of operation, lead financial advisor, and then also, as you'll find out in a second, part of our investment committee. And so today we want to be able to answer as many questions as you have, but if anything comes up after today or we don't get to it, I'm sure we'll be sharing our emails in the chat. Or if you have any questions for your own advisor, we'll be able to forward it to them. So please don't hesitate to reach out if anything comes up. And the last kind of overview point here is today is more of like a general overview. A lot of this may apply to your portfolio, but if you have any specific questions on how it really does, we suggest that you reach out to us, to your advisor, or another trusted financial professional for kind of bringing the high level asset allocation conversation all the way down to the minutia of your specific portfolio and your specific scenario. So Michael, I'll pass it back to you.
Yeah, thank you so much, Jonathan. So I think I always like to start by mentioning that, we are a firm that runs our investments through committee. It's not just the advisor making decisions. It's not just our director of investments. There are 5 of us that meet on at least a monthly basis to chat all things investments and portfolio management. And it is headed up by our director of investments, John Clements. But we also have Matt Beck, another senior financial planner, and our chief partnership officer, Brandon Miller, our founder, and another lead advisor, myself, and then Jake Zalewski, our CEO, wears a couple of hats as well. He's also our chief compliance officer, so he makes sure that we are following the straight and narrow path of compliance throughout all of this and keeping our clients' best interests in mind. And combined, we have almost, I believe it's almost 80 or 8 decades, sorry, 80 years of experience in the wealth management world, and growing. In addition to the 5 of us making decisions, we are not alone. We leverage input from many major asset managers over the years, and at least 4 per year will give us input. Try and do it on like a quarterly basis to see, what are the major asset managers and other mutual fund and ETF managers of the world thinking? What are their economic offices thinking? What is their research showing? And we're not beholden to using any of their advice or anything like that, but it is valuable to have more and more input into these very important decisions that we make. So you'll see just a few names here, like BlackRock, Capital Group, Vanguard, American Century, First Trust, State Street, just to name a few that have helped us with these exercises over the years and are ongoingly contributing to all the data that we have at our disposal and helping us make these very impactful decisions to our clients. I think to start, really, I want to emphasize that we follow something primarily known as modern portfolio theory. And I think the key here with this is it's been around since 1952. It's also the person who created this theory, Harry Markowitz, was awarded a Nobel Prize for his work. And it's probably the most common portfolio management theory that is followed by many asset managers and RIAs like ourselves when shaping their clients' portfolios. And the key emphasis is on asset allocation and diversification, and really kind of emphasizing that you should take a risk-weighted approach into how you make these decisions, and not just focus on maximizing return. Because when you account for things like human behavior, if you don't take risk-weighted approaches, you can end up seeing deviations from the plan. And so this is kind of what our theory is rooted in. And we'll get a bit more into what we mean by asset allocation and diversification here as we go along. But asset allocation simply means what is the ratio of stocks to bonds in your portfolio? So stocks being your more risky assets that lead to growth, bonds being your more conservative assets, relatively speaking, that provide income and stability to portfolios. And the good news here is like that decision alone, research shows from many companies, but this, you can see here, 88% of your long-term outcomes or the impact of your asset allocation are going to be determined by just that. The things that the media tries to get you to focus on, or if you watch Jim Cramer or something like that, they're going to focus on, buy today, or sell tomorrow, or, is Apple correct over Google right now? And really, that's a small piece of the puzzle. It also requires a crystal ball to be right. Whereas asset allocation is something that we can control to the thousandth decimal place and know on a daily basis how much we're deviating from. We can reset back to what you originally targeted, a few times per year. And it's, a very controllable thing. So I view this as good news because it's controllable. We don't need a crystal ball to help with long-term outcomes for our clients. Another key part of this is that diversification that I mentioned earlier. So when we talk about asset allocation, if someone has a 80% stock portfolio and 20% bond, that doesn't mean if you hold 80% Apple stock and 20% Treasury bonds that you're going to be kind of expecting the same results. There is some assumptions around diversification. And what that means is simply, not having all your eggs in one basket. So what we're looking at here is a chart over 2005 through 2024, showing some of the broader asset classes out there. And it shows your best performers at the top of that year and your worst performers at the bottom of that year. And as you can see, and what we want you to kind of get across here is that the colors are very scattered, right? There's some maybe trends, a few years in a row where you may see one at the top, and then that one may be towards the bottom the next few years. And we think that's important because one, it shows that you shouldn't let like past performance necessarily dictate your future investment strategy. And I think, looking at this chart, a common one or one that stands out to me is emerging markets. If you see they're the best performers in 2005, the second best in '06, the best again in '07, and then they got a 50% haircut in 2008. But then they're right back to the top in 2009. And then they kind of had a cruddy next 4 or 5 years, right? They're fifth overall or fourth overall, and then they're pretty darn close to the bottom for a few of the next few years. So again, we don't want to let past performance indicate kind of what we're going to be choosing going forward. And we also just want to, again, own all the colors. Now, how much we own, there's a bit to that. Like how much should we own of large growth companies in the US versus large value companies in the US, for example. Essentially, what we're trying to do when we think of that decision is take the global market weight of all these asset classes and say, well, if globally, where all the money's located, X% is in large value US companies, then that's roughly where we want to have a starting point, at least for what our client portfolios look like. This chart also does a great way of showing how a balanced portfolio is going to work. As you'd expect, if you're owning all the colors, all the different asset classes, you're never going to be at the top and you're never going to be at the bottom. So you have a bit more of a smooth ride over a 10, 15 or plus year period. And so if you look at this gray box here, balanced, you'll see it's consistently, in the middle. Again, like I said, never the best, never the worst. And you get pretty darn solid rate of return over that same time frame, by following the strategy with a lot less of the roller coaster of emotions that may come from being in more single securities or more concentrated in single asset classes. So we view diversification as something that is instrumental to success of client portfolios, not only in helping for long-term growth, but also back to modern portfolio theory, focusing on risk and helping limit downside.
Michael, question. For the
Yeah.
chart, is standard portfolio has all of the colors already in it based by design?
It does, yeah. And it's following that same kind of theory we are, and that holding them kind of proportionally to how they make up the global investment landscape.
Okay.
Yeah.
Awesome. And then, yeah, if anyone wants a copy of this, we can supply it because I know it's kind of hard to read on the screen.
Yeah. Yeah. So I'll hand it back over to Jonathan here to kind of focus in on some of the broader asset categories. So starting with stocks and equities.
Yeah, thanks, Michael. Yeah, a question we often get from clients is, okay, I understand asset allocation, but what am I actually going to hold in my portfolio? And we'll begin to define that here. So we'll start with stocks and equities. As you can see on the slide, we have a definition that a stock is a fractional ownership of the issuing corporation. You can get that exposure to stocks in a couple different ways, but the classic example is, a single security, a single corporation, let's say NVIDIA or Meta. If you own NVIDIA or Meta stock, you're a partial owner of the corporation itself. You can also own stocks, get exposure to them in a different way and through a fund. And so instead of owning individual stocks, you'll be an investor in a fund, and that fund will have a group of stocks that is going to track maybe a benchmark, but give you that exposure to the stock and the equity that you have instead of owning them each individually. And I think as Michael touched on a little earlier, stocks and equities are often where the growth of the portfolio lies, which is a good thing, but also where the volatility and the risk in the portfolio lies as well. And so there is definitely growth potential, but it comes with some ups and downs. I think 2025, we remember the Liberation Day, as our portfolio manager jokes about it, but Liberation Day in one sense or another that Trump announced, and I think some stocks were down 20 or 30%. Just in 1 or 2 days. And so that's a really good highlight of where the volatility can come in. But then you may look at the stock market at the end of the year and see it might be up 14 or 15%. So it's a give and a take for sure. And so back to how do you actually get exposure to stocks? So at Brio, we really look at the fund side instead of the single security side. And there's two main type of funds that we're going to talk about, which are on the right, which are mutual funds and exchange traded funds. We could talk about the difference in these and how they trade differently for a while, but we'll just do a high level definition. So for an exchange traded fund, those are typically managed in more of a passive way. And so the manager will have a collection of stocks in their fund. You'll invest into the fund. And the goal that the manager will have is to actually track a benchmark. Now, what a benchmark is a good example is the S&P 500. There's a couple of vehicles you may be familiar with, SPY and VOO, which are, I believe, iShares and Vanguard are the fund managers. Those are S&P 500 ETFs. The benchmark is the S&P 500. The goal of those exchange traded funds is to track the benchmark, give you the similar return, very close to the same return of the S&P 500, while hopefully limiting the volatility that you'd see if you own 500 single securities instead of just one portion of the fund. And so, like I said, ETFs, a key part is they're more passive. When we look at mutual funds, it's very similar idea. It's a fund, but instead of being more passive and tracking the benchmark, the mutual fund's goal is actually going to be more active, buying and selling more often and trying to beat that benchmark. That can be a good thing or a bad thing, but what usually means is there's going to be more transactions within the fund, but more and higher fees. And so sometimes, it's worth it to go for a mutual fund. When you look at the Brio portfolio, we have, portfolios where mutual funds fit in great, but the majority of our asset allocation is going to be into ETFs due to a little lower fees. And then it's often actually really hard to beat the benchmark. There are certain bits of the asset classes where, the mutual fund will help, but mainly, we like to focus on the more passive side and just track the benchmark and limit the volatility you may see. So I think we can go to the next slide and move to fixed income and bonds.
Jonathan, I have a question. For a mutual fund, is there any sort of ballpark number of individual elements that are wrapped within that fund?
It can vary. So, you can have a mutual fund that tracks the Russell 2000, and you can have a mutual fund that tracks the S&P 500. And I think I actually saw recently, maybe there's a mutual fund or an ETF that tracks the Magnificent Seven. So it can be a collection of 5 or 6 securities all the way up to, 2,000, 3,000. So, typically most people will be tracking the S&P 500 or the Russell 2000, so it'll be in the higher number. It won't be under 100, but unfortunately it varies, so no real great answer.
Okay, no, that's perfect. Thank you.
And so like we talked about with stocks, where we talked about the riskier asset class, the growth of the portfolio, we'll look kind of on the flip side, where we'll look at fixed income and bonds. And so what those really are, fixed income and bonds are synonymous. I think the easiest way to describe them is just IOUs. And it just depends on who actually owes you the money. On the left side, you can see there's treasury, corporate, municipal, different type of bonds. And what you're doing with the bond is you're basically handing over, the state government, the local government, or the federal government, or maybe a corporation. You're paying them some money. They now owe you that money in return, as well as a little bit of interest. And so at the end of a fixed period of time, you'll get that money returned with a little bit of interest on top. Now, where do fixed income and bonds fit in with stocks? So unlike the riskier side with a maybe higher growth potential of stocks, fixed incomes are what we like to call the stabilizer or the ballast of the portfolio. They're less risky, they're a little less volatile, and they're very helpful in working against downside risk, limiting the downside risk that you may have. And actually, importantly, they grow the portfolio in a slightly different way than stocks. Stocks, you see a lot of appreciation, and so you may see the value of the stock goes up and up. For fixed income, you can hear it in the name. They actually help you grow the portfolio through income, and so you'll get paid a little bit of income on that interest from the IOU. And that'll help grow your portfolio in a slightly different way than the appreciation in the stock market. So we love to talk about fixed income and bonds. Sometimes clients don't love to hear about it. It's not the most exciting thing to hear, but they're really helpful. In the bad times, they help limit that downside risk, like I said. In the up times, people like to complain, maybe you're not getting the full return potential as in the stock market, but we think it's a necessary step to take for protection and keep your volatility within the portfolio at a minimum. And then the last point is similar to stocks. You can access fixed income and bonds individually in a single bond, or you can access them through a fund, fund of bonds, and it can be a small fund with 10 or 15 bonds, Shannon, or it can be something a little bigger than that as well. But yeah, I'm not going to redefine mutual funds and ETFs, but a similar concept of active versus passive and tracking a benchmark as well. So we can go to the last slide on the definitions. So this definition is both easy and hard at the same time. Alternatives are basically everything else because it doesn't fall into a conventional category. It can be wide ranging. I think everyone will recognize some of the terms on the right side, the flashy terms of private equity and hedge funds, venture capital, as well as real estate and commodities. I think a good way to describe alternatives is investments that aren't necessarily publicly traded, or if they are, they're very thinly traded. And so real estate's a good example where we're not really talking about your primary residence as an alternative, but we're talking about data centers or office buildings. And so those are going to be, you can't sell just one office in a 50-unit office building. And so they're not going to be traded quite in the same way as a stock, but they're going to be able to provide a very different aspect in your portfolio. And commodities, I think a couple of good examples that we've heard about in the news recently, silver and gold, but these real hard assets, precious metals, and you're actually at the very fundamental side, you are investing in literally the hard asset of gold and silver. For private equity, hedge funds, and venture capital, just a quick definition, but those are going to be funds. There's going to be a fund manager, and they're looking at private companies, trying to buy those private companies up through a lens of profitability down the road with the idea of taking them public or selling them in the private market. And so all five of those either capture not being publicly traded or just being very thinly traded. Why are we even talking about alternatives? Because they bring a lot of diversification to the portfolio, and they often move very differently than fixed income and equities. The economy treats alternatives slightly differently. Sometimes they're viewed as a safe haven or an inflation hedge. I think most people might be familiar with gold's role in that. But sometimes they're riskier with higher growth potential. I think most people might see that as private equity and hedge funds. It really depends on the underlying strategy of what you're looking to do with the alternatives. But it's a space that we're really looking to explore. We've begun to explore, and we're excited about. There's for a long time there's been a little bit of concerns with alternatives because of that thinly tradedness or lack of publicly tradedness. There's an issue with liquidity. But as the markets have begun to develop, alternatives have begun a little bit to democratize. We've actually been able to find a couple of great funds that are as liquid as a stock and a bond, but provide the benefits of the diversification of a stock and a bond, or to add to the stock and bond too. That's been our portfolio manager has been very excited by it. Back in the old days, alternatives often had high investor minimums, high fees. They were reserved for the ultra wealthy investor. But as the markets have begun to kind of democratize a little bit, those fees are coming down. The liquidity is really being boosted for the more common investor. And we think the diversification benefit and how it can work alongside fixed income and equities has been great so far in our portfolios and will continue to be great as well.
Awesome. Thank you, Jonathan. So moving into kind of how we construct these portfolios, what a portfolio might look like, and give some expectations around that volatility as well as average rates of returns. I think this chart does a really great job of demonstrating that. So this shows you for almost a 100-year period from 1926 through 2024, different asset allocations and what their upside, that top number is. So the best ever year, the worst calendar year at the bottom, and then the average annual rate of return right there in the middle. So starting on the left, that's a 100% bond portfolio. So kind of your most conservative portfolio from an asset allocation perspective. And then 10% increments all the way out to the far right side, which is a 100% stock portfolio, which is inherently your most risky type of investment there. And so as you can see, the top and the bottom get wider the further out to the right you go. So the more equities, the more stocks you have in a portfolio, the more upside you could potentially expect, and the more downside you could potentially expect. You also see a higher average rate of return. So think more risk, more reward. So what's pretty common with most of our investors is, of course, we're going to assess every single person's individual risk tolerance. We're going to really understand what their timeline is with the monies that we're investing. But say you have someone that's very young and saving for retirement. We've got 30 years at least until they plan to ever need to withdraw from those funds. You'll more than likely see people start out on the far right, maybe 80, 90% in equities, depending on their unique risk tolerance, and then gradually kind of slide to the left as they age, as they get closer to actually needing that money for its intended purpose. What you'll also see, and I think is pretty interesting, is there comes a point where your downside essentially flattens out, right? There's not much of a difference between 13.1% downside and 15% downside. And your average annual return, though, takes a pretty drastic step from 5% up to 7.1. So there is a point in which it doesn't make much sense to take less risk. And a lot of investors will kind of flatten out in that 30 to 40% equity side of things. So, there's also more nuance to it when you're saving for a goal that isn't necessarily retirement. Maybe you're saying, hey, I want to start this fund to start this portfolio with a couple $100,000, and this is for my down payment in 5 to 7 years' time. Even if you have a high risk tolerance, that doesn't mean you should necessarily be on the right-hand side of the chart. Maybe you want to land somewhere more in the middle, because timing of when you're going to take it out and having no crystal ball to determine if that year is going to happen to be the year that Trump announces a bunch of tariffs, for example, can be tough. And so, throughout our entire process, we're going to be constantly communicating with our clients to make sure that we understand the timeline, that timeline isn't changing. And as we move closer to it, starting to get more and more conservative until the point that maybe we're 2 years from making that transaction. Maybe at that point, we even pull all the money out of the portfolio, say, hey, we've done great with this. We've got some return. Now let's be conservative and focus on ensuring that we have the money available to accomplish that goal. Because the last thing we want you to do is have like your down payment money or the money for whatever goal, and then it gets a 20% haircut, and now you got to save quite a bit more to get there. So this process requires constant communication. It requires understanding this bottom number and not just focusing on the average return or the top line, which people's eyes tend to drift towards. Is they want to focus on that optimistic outcome. We unfortunately sometimes have to step in and give a dose of reality that maybe the last 15 years have been pretty kind to us overall in the stock market. Historically, though, one in every 3 or 4 years is actually a down year in the market. And so we've got to anticipate that as best we can and prepare for it. And that's when coming up with this, diversified asset allocation driven approach kind of comes into play. I also would point to the most aggressive portfolio being 10.5% average annual returns. Oh, apologies. And so I think it's just important to mention that, like, anytime you hear things that sound too good to be true, like consistent 15% rates of return, you're probably taking on even more risk than negative 43% downside. And maybe it is too good to be true. So I think setting expectations with data like this is very important as we move throughout that process. There's other things that kind of happen behind the scenes other than having those conversations with clients and making sure we're on top of risk tolerance and time frame, and things that maybe you don't necessarily see because once we set you up with an account, we have discretion to do these types of things because we know they're in your best interest. The first one is going to be tax efficiency of asset allocation or asset location. So what we mean by that is, there's certain investments that make sense in certain account types based on their tax efficiency. A great example of that for many of us in California, it's a high income state tax or high state income tax state. And so, California municipal bonds pay us tax-free income both at the federal and state level. However, because of that, they pay a much reduced income. Maybe they're paying 2.5%, and in a savings account, you can get 4% right now. When you do something called the tax equivalent yield, that may still be that you're coming out ahead by accepting that lower yield because of the tax benefits associated with it. However, we would never want to hold that type of asset in a retirement account because they don't issue 1099s for dividends and interest. And you don't need to focus on tax efficiency. So we need to be really mindful of which investments we're placing in which account types. We may also go a step further and think, well, your Roth money is your best money, right? It's growing tax free. Maybe we're really aggressive in that account, and in your pre-tax IRA, we're slightly less aggressive, and we kind of balance them out and view the two holistically and what is their combined asset allocation. So we can get more growth in the tax-free accounts, slightly less growth in the tax-deferred accounts. But all in all, if you view them together, they're moving as you would expect with that combined asset allocation. Additionally, like I mentioned earlier, our investment committee meets very regularly. We get input very regularly from outside investment companies. So we're constantly doing due diligence to make sure that we are in the right portfolios. We have the right funds, the right fund managers. And those things change, right? Maybe another fund enters the market at a cheaper price point, or maybe a fund manager retires and they have a more junior person stepping into their role. We need to be on top of those things for our clients and decide if we're comfortable with those changes, and ultimately just try and make the best decisions for our clients. Another one is rebalancing. And we can really butt heads with investors at this point in time with rebalancing, because inherently what that means is saying we're going to reset our portfolio back to the original target. So for example, if we chose 60% stock, 40% bond, over time that will fluctuate if we don't do anything. And because equities tend to outperform, usually what that means if we don't rebalance is your portfolio is going to get riskier and riskier and riskier over time. But what it also means is we're selling your winners to buy your losers. We're selling the things that have just performed better to buy the things that have performed worse. But we know, again, that that is the right thing to do because we need to focus on your risk and we need to bring you back to where you kind of originally signed up for. Otherwise, you might find yourself with a much more aggressive portfolio going into a year like COVID, where we see the markets just tank and nosedive all of a sudden. And, our goal is to prevent you from reacting to that and to prevent you from experiencing more downside than you ever intended to have originally signed up for. So what we do on a semi-annual basis is rebalance. We also have technologies that tell us when portfolios may have drifted between those semi-annual rebalances more than kind of our tolerance thresholds for them. And our technology will notify us and we can make a decision around what we want to do there, whether or not we need to contact the clients. Rebalancing can also incur taxes, right? We're selling something that has performed. So depending on the account type, that may be capital gains that you now have to pay tax on. And so we just need to be mindful of that. But if we're focused on tax efficiency of asset location, hopefully we can mitigate it. And there's also this concept known as tax loss harvesting that we very much believe in. I could spend probably an hour on tax loss harvesting and all the questions associated with that. But at a high level, what that means is we're going to sell things when they drop in value inside of a taxable account, like a individual or a joint account or a trust account. And we're going to buy something very, very similar almost immediately. We can't rebuy the exact same thing because there's something known as a wash sale rule. But by selling and buying something very similar, we're ultimately keeping your portfolio relatively the same as how it was, but we're capturing those losses, which can be used at the end of the year if we have some gains to offset them. They roll forward with you year over year, so they never go to waste. And ultimately, it's a way of us providing more value to you, even if it's not showing in the rate of return. We can provide that tax value to you. And then, another way is year-end distributions. Not a lot of people realize, but mutual funds, some ETFs have the ability, based on how much trading activity that happens in them throughout the year, to say, hey, we've got all these distributions. We pass these along to our investors. Now, if we're mindful of when those dates are, we can actually get out of that fund before they pass that along to the investor. And so that's an annual exercise we do in Q4. We're going through it right now to just ensure that we're mindful of what those are going to be. Do we want to take a tax hit by selling that thing? Maybe there's capital gains associated with it, and that'd actually be worse for the client. So there's some nuance to it. There's some decision making to be done. But the good news is a lot of ETFs just don't do this due to the way they're structured. And that's another reason, outside of believing that passive management tends to outperform active management, tax efficiency is another reason why we use those ETFs. So there's a lot to unpack on this slide. Our portfolio manager could talk your ear off about it. Your advisor is very knowledgeable in all this stuff. So again, just want to reiterate, please reach out if you have questions about any of this stuff, or you kind of want to deep dive into one of these topics, and we'd be more than happy to. I just want to pass it back over to Jonathan for a couple final slides. And this is all around investor behavior. And I think kind of back to the whole modern portfolio theory and accounting for human behavior in the decision making. We view this like psychological part of investing as just as important as the asset allocation side of things. So Jonathan, with that, would love to kind of hear your thoughts here.
Yeah, definitely. So, first of what are we looking at here? So what we're trying to show is the cycle of human emotions that come along with the market cycle. So, one thing that I like to point out at the start is it starts with optimism and it ends with optimism, and there's a whole lot of emotions in between. And so we as a firm and as your advisor kind of believe that a lot of our responsibility is being able to coach and talk with the clients through these emotions. Because in the state of euphoria, when the markets are up and you just can't see anything but up and to the right, a lot of clients will really struggle with the idea of rebalancing. Like what Michael said, you're selling your winners and you're buying your losers. What are you saying? But it's about having that goal and keeping to it and keeping to your risk tolerance and ensuring that your portfolio is tracking what you want out of that portfolio and is not being swayed by these emotions of when markets are up or markets are down. On the flip side of the euphoria, there's despondency, which is a good way to describe it. But that's going to be the time when everything's going down, and the last thing you think is it's a good time to put more money in the market. Or if I don't take my money out today, tomorrow it's going to be down even further. And those are emotions that as advisors we understand. I mean, as individuals who are also investing in a market too, we also understand that as well. But it's really having that unbiased third party to be able to take a step back, look at the bigger picture. Optimism is hopefully around the corner, but more importantly, especially in the despondency stage, we like to say everything's on sale. That's also maybe one of the best times to get back into the market, is because you're able to buy everything for much cheaper, even though that's hard to believe. That's one way to view it. And I think one of the most important parts of the investor's behavior is understanding how emotions affect people when it's their money. And like I said, it happens to advisors in their own portfolios as well as clients or other investors. They can almost get in their own way by letting these emotions, decide some of their financial decisions. And our role is working with you and being able to understand that, it really is a cycle. And sometimes, we really want to help coach you to kind of push you through that cycle and fight off some of the emotions that are really hard not to feel with your own money, and just having trust that the plan we set out, the portfolio that we're building, is applicable for you and fits you well. And as long as you stay the course, we think the financial outcomes at the end are going to be much better than any sort of time in the market, or selling when the markets are down, or not selling when the markets are up. I think we can go to the next slide. It's going to tie in here. And so, the idea here is it's hard not to lead with your heart instead of your head. But the markets are purely data driven. The markets don't care about the investors' emotions, and it's the advisors do. And so in this slide, I think the big takeaway is what we like to tell our clients, and I'm sure you've heard it, is it's all about time in the market, not timing the market. We work with you at the start to set a portfolio, to set a goal. And we really think as the unbiased third party, as the people that can take a step back, really try to make sure that you stick the course. I think this slide is actually really helpful to show you that over a really long time frame, even just a couple of days can drastically affect your outcomes, and it really highlights the importance of staying in the market. So it might be kind of hard to read, it might be too small, but the graphic on the left side is trying to show what it looks like if you invested $10,000 into the S&P 500 from 2003 to 2022. So roughly a 20-year timeline. And what it looks like, should you invest 10K and never leave the market? If you invested and you left the market for the 10 best days, the 20 best days, the 30 best days, and so on. And I think it's really interesting to look at. So if you stay in the market the whole time, that 10K would have turned into 64K. If you miss just the 10 best days over a 20-year time frame, that 64K gets almost cut in half. The 20 best days, it gets cut into a quarter, and the 30 best days, you're back at $10,000 after 20 years, and all those emotions were for nothing, basically. That being said, hopefully no one is unlucky in 20 years to miss the 30 best days in the market. That's not really what we're trying to say, but it's kind of showing that even just a couple of days over 20 years can drastically affect the outcome after 20 years. And even more importantly, it might be hard to see as well, on the bottom side underneath the bar chart, there's those kind of hill-shaped little graphics, and what those are showing is a little bit of unfortunate news, but the markets often work against your emotions, and kind of why I said the markets don't care about the emotions of an investor, because most of the best days come during the worst times. So the 10 best days pretty much over the last 20 years all came during the 2008 crisis and during COVID. And you can kind of understand it, because if the market goes down so much, it can rise just as much, 1 or 2 days later. And so if you miss those days, if you're letting that despondency come in, where during COVID and during the financial crisis, it's hard to see a way out, and hard to see that optimism in the future, and you let those emotions take care of you, you might miss one of the best days over 20 years. And missing that one day really can have $1,000 or a couple thousand or tens of $1,000s difference in your portfolio. And so our job is to work with you as a client, and to work with, more importantly, everyone client as a human, and understanding the emotions of people's money, as well as understanding the importance of trusting the process through the market cycles. And we try to come at that in 2 ways. One is that conversation with the clients when times may be good or times may be bad. And then 2, which I'm sure your advisor loves to talk about, is cash reserves. So it's really important in our portfolios to ensure that there is a cash reserve that can limit that feeling of despondency, because you have the cash built up to get you through a market downturn. And when the market comes back up, you'll forget that almost even happened. And so we at Brio really emphasize the importance of having enough cash to get you through. Depending on your own situation, it can be 6 months, it can be 12 to 15 months. That's a question for your specific advisor, but it's ensuring that the liquidity is there. When those values drop and the market goes down, you're comforted that each month you're gonna be able to pay the bills, you're gonna be able to live your life just as is. You don't need to change your way of living just because the markets might be down 10%. And so that was all I wanted to touch on this slide, Michael.
Yeah, thank you, Jonathan. I think the key there, just back to the slide, is sometimes you may be tempted to react, and sometimes people may be forced to react, and that's when that cash reserve comes into play, and where we spend probably most of our time with clients is ensuring they have enough cash so they're never forced to react. And unfortunately, sometimes people don't have that person in their corner there, and they are forced to miss some of these best days.
And Michael,
But
haven't you
yeah.
shared in the past that some of the best days are like very close to some of the worst days within those little bubbles?
Yeah, it's not just the worst years. It's like I think it's like 7 out of 10 of the best days happen within 2 weeks of the worst days of the year too. Don't quote me on that, but it's some
Yeah.
data point like it. And as I'm sure depending on which 20-year period you look at. But another interesting thing is I've seen this chart, the same exact graphic from I think it was like 2000 or 1983 through 2022 or 2002. So that 20-year period preceding this one, and it's almost identical. There's similar 10% plus days, that are in those worst years during that 20-year period. And the same exact chart, kind of like 10 grand would have turned into 60 some thousand. If you missed the 10 best days, it's half of that, then a quarter of that, and so on. So I don't want to say every 20-year period is going to look identical to this, but I know at least that 20-year period that we're looking at here and the one preceding it were largely identical. Yeah, so with that, we're going to wrap up here. Just want to say thanks again so much for spending an hour on a Friday with us. Hope everyone has some fun weekend plans. And again, I think we'll have our emails in the chat. It's michael@briofg.com, jonathan@briofg.com. And also don't hesitate to reach out to Shannon. We'll make sure your questions get answered. And I can also open up the floor right now if anyone wants to chime in with questions.
Nary a question to be had. Okay. Well, if that changes, feel free to reach out. As Michael said, emails are in the chat. We're always just a phone call or an email away. All right, Pollock, question?
Sure. How do you prepare? So, I get that we have our cash reserves, that'll be anywhere from, a year to 2 years or whatever. I'm a nerd, so I'm a preparedness person. But how do you prepare for a real calamity? I mean, maybe you can't, right? But I look around the world right now and I see the potential for an AI bubble to burst, to see more money being put into private equity than public stocks. And so I am not the expert, right? I don't know what this means to me other than, let's go to your emotional chart, right? And say, I'm in my 70s. So it's like I've worked a long time and I was bankrupt, like, 15 years ago. So I've been in the hole and I've come out of the hole. But how do we prepare for that? I mean, is it more cash reserves?
Yeah, Paul, it's a really great question. And you've hit the nail on the head with cash reserves being the number one that we would want to focus on. Secondarily would be your asset allocation. And so, how much growth do you really need from your portfolio at that stage of life? Are we taking on too much risk? But if we look at like 08, 09 as a good example of a pretty extreme market pullback and correction period, it took about 2 years for markets to recover. So for retirees with no other income sources, I would point to having a 2-year cash reserve on hand, so that you can pay the bills and kind of maintain your standard of living. During those times, I think a lot of people that are very mindful of this stuff tend to also cut expenses, even if they know they have a 2-year reserve. So really, that can get prolonged maybe to 2.5 or 3 years. But our goal is hopefully that you don't have to do that. And you can keep living your life as is. There are certainly probably worst case scenarios in history where having more than a 2-year cash reserve on hand would have made sense, but you also want to be mindful of that cash drag, as we call it,
Right.
knowing that cash is going to usually
Right.
underperform inflation, and that's another way of loss as well. A really interesting chart, just to really overload everyone here. We call it, or it's called an Andex chart. And this is Shannon's shaking her head because there's so much here, but we can share this as well.
Right.
I think it's fascinating.
Yeah.
And I'm going to point to the top section here, and I'll zoom in on a couple of things. Don't intend all of you to see every bit of data on this because it's a lot to unpack in a couple of minutes here. But this shows the history of the markets all the way back through 1926 through the end of 24. And each one of these lines is just representing essentially a different asset class. Really, what I want to focus in on, though, is these plot points throughout the years. So you go back to like the 20s and excuse me, the 20s and 30s, and you had like the Great Depression. You had the banks and the stock markets closing for a couple of weeks because of how bad things were. You can move out to the late 30s and 40s. Of course, you had World War II. Move out further, you've got the Cold War, you've got the Bay of Pigs, you've got civil rights, the Vietnam era, where we've got just maybe as much divisiveness amongst the U.S. as we have today. Further along, you've got, the inflation crisis and the 30-year fixed mortgage hitting 18.6%, which I just can't even fathom with today's home prices. Keep going a little bit further out, you get to, 9/11 and, the '08 financial crisis again, and then, of course, COVID and what we're dealing with today. And, I think the thing that the reason I'm bringing this up and the thing I'm pointing to is that this is not necessarily unique times in the way that we're feeling. Sure, they're unique times in the way that things are, but there have been plenty of times where it's felt like the world's almost ending. Or if you think back to the Bay of Pigs and Cuban Missile Crisis, where the world literally almost did end, and the markets have still, found a way to move upwards. And, humans have powered through those times, and, the economies have survived major pullbacks and failures and things like that. And so, while we don't have a crystal ball, we can't predict the future. We believe, with 100 years of data and 100 years of history here, that the markets should continue to do so. And there will be many, many bad years in years to come, but we think there'll be slightly more good years. And so we think staying invested and not trying to over prepare for the unknown is also important, but still being responsible with like the data we have at our fingertips to be prepared for like those kind of average or above average market pullbacks like '08, '09, using that as a proxy for how much cash we should hold and so on, is a good thing to follow. I hope that's helpful.
We never want you to emotionally fall on the despondency part of the chart. So call us, let us help you before you get into that negative curve. All right, any other questions, folks?
Awesome. Well, thank you all again very, very much. We appreciate your time.
Thank you, folks. Next week, we have What's Next, which is our retirement roundtable. That's Tuesday at 5 p.m. Then we've got next month, our Smarter You series is Friday. I want to say the 21st. It's on financial mindfulness. So kind of how to recalibrate your relationship with money. So join us for that as well. And reach out if you have any questions along the way. All right. Thanks, everybody.
Thanks so much, everyone. Have a great weekend.
Bye for now.